Hello and welcome to day 4 of Financial Empowerment. Let's take a few minutes and recap some of the things that we have already covered. On day 1, we went over discovering your financial behaviors. You were able to take an assessment and determine what your actual financial behavior was. On day 2, we were able to determine where do you stand today financially, because before we can go forward, we have to know where we already are. Okay. And then on day 3, we went over your expenses, the various types of expenses, fixed and variable expenses, how your expenses or your income should be allocated. And then we also talked about how your expenses should be allocated. We talked about the 70-30% rule, 30% for paying yourself first and 70% to live off of. And then we also talked about how your 70% should be allocated. And today we are going to be talking about determining what your net worth is. But before we get into that, I want you to take a look at a case study that goes over some of the subject matters that we have already covered. I'll see you in a couple of minutes. I'd like for you to meet Larry and Linda Jones, okay? And I'm going to tell you what their story is. Okay? Larry and Linda, they've been married for 2 years, and they have a combined household income of $75,000. Okay, Larry is a 28-year-old IT professional making $50,000 a year, and Linda is a 26-year-old customer service rep making $25,000 a year. Okay, Larry and Linda's minimum monthly expense outlay is $4,537. Excuse me, while their monthly income is only $39.86. So as you can see there, they're already in the red, and they need our help. They need some direction, okay? They are currently leasing their vehicles, which are due to be turned in at the end of the year. They attend a local church, and they believe in paying tithes from their gross income, okay? Their total debt is $45,200, of which $5,200 of that is credit cards. And the remainder of that debt is student loans. Okay, they have been discussing purchasing a home and starting a family. And I like to say about when we deal with couples, I think it's so important that financial counseling is done prior to the walk down the aisle. And I can't tell you how many couples I've spoken to where when you're talking to them about finances, they'll say something like, well, she pays for this and I pay for that. It's divided. No, you're one. So everything, comes together. And I make the recommendation of, you probably should have a community account where everything goes in. And then if you want to have your separate accounts for mad money or what you want to purchase, then you have that. But there should be a community account where all the bills are paid out of and things like that. So it's a combined effort. And when I'm meeting with couples, I have a policy that I need to meet with both of you, because you both have to be on one accord in terms of the plan that we put in place, because if they're not, then it's not going to work. And so it's very important when you're dealing with couples that they're on the same page, okay? Also, they have $5,000 in a 3-year CD that was given to them as a wedding gift to go towards the down payment on a new home. And Larry gets a year-end bonus of $4,000 after taxes, and they generally get approximately $2,000 back from their tax return, okay? And so those are things that some of the things they could have probably talked about before walking down the aisle of, how are we going to manage this? They were leasing vehicles that came into the marriage with them. They were already under contract. So those are part of their expenses, as they come in. And so the first thing we're going to do is we're going to do the discovery, look at what's coming in. And if you notice here, I've bolded the gross household income because they do believe in paying tithes off of the gross. And so this is their gross monthly. They're bringing in $557.69. on the monthly basis. They're contributing to health insurance from their employer. And if you notice here, I have the 401k highlighted because neither of them are contributing to their 401k. So that's something that we would address with them immediately. Okay, and then we do their taxable income, because today, a number of years ago, the laws kind of changed where now your tax after your insurance, your 401k, and if you have a flexible spending account at your job, all of that comes out prior to you being taxed. So what we're showing here is what their actual taxable income is. That's what that 5315. I've got this broken down bi-weekly, what they bring in bi-weekly, and then what their monthly is here. And so we're showing what they're taxable, and based on what they're making, roughly according to the IRS, they're right in about the 25% tax bracket, okay? And so then after that, using that rate, this is their net income, what they're actually bringing home. So they're actually bringing home the $39.86. So how many know that this is really what matters? This number, it's really this number that matters, what you physically get in your hand. I mean, I don't know if any of you have ever taken the time to take that number. Your employer say, okay, I'm going to pay you $60,000 a year. But when you take that number and multiply it, it doesn't add up to, $60,000, And I like to tell my clients too, especially when it comes to when they want to purchase a home, because a mortgage lender bases the purchase of your home based on your gross, and they will do it up to 3 times what you really. I always tell my clients, I say, I would not take your income and multiply it by 2. That's what you can afford in a home. That way you'll be comfortable. If you want to fix it up, if you want to do anything, you won't be house poor. Because unfortunately in the mortgage industry, what they use as qualifiers is what's on your credit report. Now, I'm sure you all can know here, there's several things that you purchase and you participate in that does not show up on your credit report. If you have kids, daycare. If you buying clothes, that's not going to be on your credit. If you're furnishing your home, well, it may be on your credit report if you're using a credit card to pay for it, But there are so many things that we use our money for that's not reflected. A car repair, things like that, that's not going to show up on your credit report. So now you get that letter, that pre-approval letter. You're like, wow, they qualified me for this, and you're excited, and you go out looking for a house for that price, And I tell you, realtors, if your pre-approval letter is for $250,000, they're going to try and take you to the all the way up there. They will even show you a $275,000 or $300,000 house, because maybe they'll say I can negotiate it down, but they're going to take you up to your maximum, okay, if you allow them to. Okay, so you have to be in control of your finances, and don't let the purchases like that, large purchases, houses, cars, be an emotional decision. You want to be able to walk away from it easily. Okay, because if you can't walk away from it, at that point, you're making an emotional decision, and you want to separate money and emotions. Okay, so here's what they're bringing in is the $39.86. Okay. Go on. Now we're going to get to their expenses. Now I know this is overwhelming. When you look at this number, you're like, these numbers here, you're like, whoa, that's a lot of information. But that's what we're going to do when you come into office. We're going to get down to the nitty gritty. We're going to look at everything so that we know how to put a good plan together for you. Okay. So here, we've got their tithing, we've got their rent, and I've got some things right off the bat that I've highlighted because I think that it's a concern that I want to address with them, okay? So they're paying $1,200 in rent. We talked about the car leases. Linda's, she's paying $200 a month, and Larry is paying $400 a month. Emergency fund, notice that's 0. They don't have an emergency fund, okay? Their utilities, cable, I've got that highlighted. We'll talk a little bit about cable. They're paying $100 a month. Another red flag, they don't have any life insurance. Okay, that's important. They don't currently have that. And then they're eating out and entertainment. It's $300 a month, and then their spending money is about $400 a month between the two of them. So they're in the negative. At the end of the month, they're in the red, $550. Okay, so they need some help. And then over here I have their balances on the credit cards. They have 4 credit cards. So that's another thing about marriage. When you get married, you had credit cards, he had credit cards. Now we got 4 credit cards that's got to be addressed, okay? And so that's their $5,200 in credit cards right there. And then they both had student loans. Okay, so and that $40,000 is reflective of the student loans that they had once they got married. It became one debt. Okay. All right. So here were the goals that we talked about that they wanted to accomplish in 5 years. And I'm only using 5 years because so many things can change, you know, in your life that can require an adjustment of your plan. So what would you like to accomplish in 5 years? Well, they wanted to eliminate living paycheck to paycheck, like most Americans today are living paycheck to paycheck. We want to stop that. They wanted to purchase a home, and they have been discussing starting a family. They wanted to pay off their debt and then begin to build wealth. So we'll address those goals all the way up to the paying off the debt portion, okay? And that's why I call this the first step to wealth building, because before you can even talk about building wealth, you've got to know where you are financially first, you know, and you have to set a plan, and so that we can find those monies so that you can begin to build your assets, okay? So here are some of the recommendations right off that I made to them. Okay, you need to discontinue leasing the vehicles, okay, because they need immediate help, okay. They need to purchase a new vehicle using the $5,000 cash from the CD. Now, I know a lot of people will raise an eyebrow that that's their money for their down payment on their house. But we need to make some immediate changes to your finances, and you got $5,000. You need to be driving a vehicle you can pay cash for. So let's go ahead and do that, and that's going to help us eliminate the car notes, okay? So that's for Linda's car. We're going to use that for Linda's car. Larry, how we're going to get Larry's car is he gets his bonus at the end of the year. We're going to use that money, and we're going to use the tax return. Larry's going to get a cash vehicle. Okay, now this is going to have 2 positive effects. It's going to eliminate the car note, and it's also going to reduce their insurance, because if you've ever leased a vehicle, you have higher insurance. They have something called GAP, which requires it to be a little bit higher, because if something happens and you total that car or something, they have to pay it off, where usually with a lease, you're only leasing a portion of that car. And so so now their insurance is going to be reduced. So not only are they don't have the car notes, now they're going to be saving on insurance as well, okay? I'm recommending discontinuing the cable. How many of you know that cable is a want, not a need? I know it seems like we need it, but no. And so we're gonna, you know, so a funny story I tell you about me and my husband. I've always been a big believer of, you know, cable being a want and not a need. And I told my husband, I said, well, we're not getting cable, because he's a big sports fanatic. And of course, so he wants cable. And I said, well, we're not getting cable until we reach a certain status financially, because that, you know, when it comes to getting wants, you need to be somewhere, you know, certain places financially before you start getting into your wants. And so years and years went on, and you know, every time that number where I want to be financially raises and raises, so we never, you know, never reached the mark. But so now it's funny when we converted over to, and all of our friends and family knew we did not have cable, you know, and so when we went over to the digital, where the TV switched over to digital, and they were saying that you're going to have cable in order to watch TV. So folks were calling us, well, what are y'all going to do now? You got to get cable if you want to watch TV. We're going to get a box. We got the box so that we could watch TV, but we did not. We held our guns, and to this day, we don't have cable. So I love when, you know, if you go to the store and they have the people in there. And I tell you how I use it today. So you come in, they'll ask me, they'll say, yes, ma'am, can you tell me what cable provider that you have? And so I use it as a selling tool for myself to build my business. I say, well, you know, I don't have cable. Cable is a want, not a need. Here's my card. I love to discuss it with you. You know, so please approach me. Please come to my door and ask me if I'd like to switch my service, because what it comes down to, and they're saying, I can save you money. I said, no, well, actually, you're going to cause me to spend more money, because I don't have cable. So now I'm spending more money, you know, and so Also, I'm suggesting that they reduce their eating out and entertainment budget by $100, and they reduce their pocket money to $300. Go to the next one. I'm suggesting that they, and this is urgent, they need to start an emergency fund. There was a report that the average American cannot afford to pay a $400 emergency. That's bad. And see, what happens is when an emergency comes up and you don't have the funds, what happens? You pull out the credit card. So that's why this is the number one thing that needs to be taken care of. And at minimum, what I want you to do with that is $1,000. Get it up to $1,000, your emergency fund, okay? And then notice here, we'll kind of skip down a couple of things. I'm telling them, I'm going to suggest that they begin contributing to their 401k, but I don't want them to start contributing to the 401k until that emergency fund is fully funded, because that's emergency. Because when we start talking about the debt elimination part, that emergency fund is going to be key. You know, and so you need to have that. If something comes up, you're not pulling out your credit card to take care of the emergency, you're going to pull from your emergency fund. I'm also asking them to start a car fund. That's going to be important because now we're driving debt-free cars. Okay, cash cars are a little bit different than a brand new car that's under warranty, you know, that you can take in and things like that. And so we want to have a car fund so when things come up, you know, you need new tires or maintenance that you need to do, you pull from that car fund so that you can pay for those things. Oftentimes, I went to college with a gentleman and he said something to me and it always stuck with me. And he said, if you take care of your car will take care of you. But you want to make sure that you have the money to do your general maintenance on your car. And a lot of times what happens is if you don't have those funds, if you don't get your oil changes, you don't get your tires rotated, you don't get your brake pads done, then it ends up costing you more money in the long run. And usually the only reason people don't do those things is because they don't have the money to do it. So then they postpone doing it. So we want to make sure that we have that fund set up to take care of those type of repairs. Start a home fund. So we want them to go ahead and start saving, replenishing, so they have, because that was one of their goals, they want to purchase a home, so they're going to start putting money away so that to saving for that down payment on the home. And then, like I said, we want them to begin contributing to their 401k, but not until that emergency fund is fully funded. And with the 401k, what my recommendation there is I want you to contribute to your 401k at least to your company match, because you don't want to let that free money go away. So at least to your company match, which in most companies, that's usually about 3 or 4%. And the reason why I'm only going that far right now is because we're going to talk about debt elimination, and we want to take care of that before we start contributing a higher amount to the 401k contribution. I'm recommending that they find a cheap apartment. They're paying $1,200 for an apartment. I believe, you know, they don't have any kids yet. They can find an apartment that's cheaper than that and save them some money there, okay? And then I'm recommending begin using cash instead of credit cards, the envelope system. And when I say credit cards, I'm really talking about debit cards. You know, I remember in college when I would write a check, we had the ledgers, the checkbook, the ledgers, and you spend it and you write down and you tracked, you know, but when you have a tendency to use those cards, you're just swiping, you're not going back home, and most people are not going back home reconciling what they just used that card for. And the next thing that you know, and if you're not tracking that, and we'll talk about, but I don't like to call it a budget. I like to call it paying attention to where your money is going. You know, because oftentimes what people do, they're just swiping the cards, and then they get a cup of coffee that costs $2 and it ends up costing them $37 because the money wasn't there. And so now they got the bounce fee. Well, as you notice, when we went through these expenses, there were no bank fees as part of the expense. So that's not in the budget. Bank fees are not in the budget. So we don't, in this process of wealth building, we don't want to be paying bank fees. I hope you enjoyed taking a look at that case study. And so now we are ready to move on determining how to calculate your net worth. So please turn to page 13 in your Financial Empowerment Workbook. And with your net worth, all net worth is your assets minus your liabilities. That gives you your net worth. And so you're going to go through this exercise in the workbook where you're going to list all of your assets and you're going to list all of your liabilities. So on page 13, there's different types of assets. You have your cash assets, which includes your checking account, any savings that you have on hand, your savings account, any money markets that you may have, the cash value of your insurance policy if you have a cash value, and then other cash assets that you may have. That is what you want to list under for your cash assets. And then on page 14, you are going to list all of your personal property. So any homes, real estate that you may own, furniture, equipment, collectibles, those are the things that you're going to list for your personal property. Okay, and then you'll total all of those up. And on page 15, you're going to list all of your investment assets. Okay, so 401k, what's the balance in your 401k? And if you have an IRA set up, what's in that? If you own any stocks or bonds, investment property, mutual funds, I want you to list all of that under your investment assets. Okay, so that once you get done listing your investment assets, that is going to conclude your assets. Okay, assets is everything that you own. Okay, and then we're going to start going into listing your liabilities, and that begins on page 16. So while you may have a home listed as an asset, if you still carry a mortgage on that home, then the mortgage is considered a liability. So you're going to list the balance that you have left for that home that you have to pay back to your lien holder. If you have any car loans, those are considered liabilities. Student loans are considered liabilities. Personal loans, credit cards, medical bills that you may have. So anything that you owe out, not expenses. I don't want you to confuse liability with expenses. Liabilities is debt that you own. So you want to list all of that here under liabilities. Okay. So I'm going to give you the opportunity to go and list all of those, all of your assets, all of your liabilities, and then we'll come back and talk about calculating your net worth more. Okay? I'll see you in a few. Okay, so were you able to list all of your assets and all of your liabilities? Now what I'd like for you to do is take those totals. So take the total of all of your assets and take the total of all of your liabilities, and that is how you're going to subtract your liabilities from your assets, and that is going to give you your net worth. Net worth actually defines how wealthy you are. Ideally, we want to have a positive net worth. And so when you did your calculation, if you have a positive net worth, then now you want to look at in what ways what can I do to increase my net worth? That is what we call leveraging the income that we have or monies that we have coming in and making it grow into wealth, because net worth actually determines your wealth. Okay, so some of you, if you have a lot of real estate or you own a piece of real estate, that can really boost your net worth, providing you don't owe a lot on the property that you own. And so now if you calculated your net worth and you found that you had a negative net worth, meaning your liabilities exceeded your assets, then that means we need to look at how you can reduce your debt. So we'll go back and we'll look at ways that will help you kind of do some techniques that you can do when we get into the spending plan on ways that you can reduce your debt so that you can come out of the net worth and begin to come into a positive net worth, and then from there begin to increase your net worth, thereby growing into a more wealthier place. Okay, so that is it for today, and tomorrow we are going to get to the most exciting part of the financial empowerment, and that is the setting up of your customized spending plan. Okay, I'll see you tomorrow.